from our studios in Atlanta, this is CarBiz Today. And here now, Bridget Fitzpatrick.
Hello everyone, Bridget Fitzpatrick here, and thanks so much for joining us today for the Kerrigan Advisors Market Update. Today we're joined by Ryan Kerrigan. Ryan, thank you so much for being with us today.
Thank you, Bridget. Good to see you again.
So what is going on in the automotive retail marketplace?
Well, the Kerrigan Index was up 4.4% in July, with some really significant moves. Sonic was up 18%, AutoNation up almost 16%, Lithia up over 11%, and Asbury up over 10%. And the only component stock that was down was Penske, which was down about 5%. But it's worth noting that Penske has very significant operations in the UK, and Brexit uncertainties are pulling that stock down.
So overall, a solid month.
Yes, a solid month. It's worth lifting up and taking a longer view, though. The Kerrigan Index is up over 37% year to date, as compared to the S&P up 19%. Now that's an incredible increase, and both Lithia and CarMax both posted all-time highs. And this is all going on at a time when SAAR is edging downward.
What is causing the disconnect between car sales and these stocks?
Well, it is a complete disconnect, but some of the things we've been discussing for many months now are starting to play out. In this declining SAAR environment, dealerships are really focused on expense control and shifting to the higher margin parts of the business model, namely F&I, used car, and fixed operations. And this new emphasis is really starting to impact performance in a very positive way.
Are dealers able to grow revenue by focusing on these other parts of the business?
Yes, they are. Even as new car volume is falling, dealership revenue is up 3.9% year to date. And this is driven by the used car department, which is up nearly 6%, and fixed operations up a very strong 7%. So dealers are absolutely driving revenue growth despite new car volumes being down.
And how does that translate to gross margin?
Well, that's the beauty of this. Dealers are shifting to much higher gross margin businesses. The gross margin in used cars are 2 times that of new, and the gross margins in fixed operations are nearly 9 times that of new. So if you look at this profit chart, you can see this really starting to play out. New cars are now only producing 9% of dealerships' gross profit, down by almost half from 2012. And fixed operations now represent over 50% of dealership gross profit. And F&I now represents over a quarter of gross profit. So as we predicted, dealers are really getting very focused on the higher gross margin parts of the business.
How about profitability?
NADA averages have profitability up 1.4% year to date, but we frankly think that's understated. If you look at the publics, you're seeing much larger increases. Sonic's earnings are up 57%, Asbury's up 7.5%, AutoNation and Group 1 are both up over 3%, and Lithia up 2%.
Okay, so we have SAAR down, but profits and stocks up.
That's right. And I think it's worth noting the stock market increases are pretty darn remarkable when you think about all the discussion of technology and disruption in our industry. Remember that stock prices are supposed to reflect the best thinking of the entire marketplace about the future earnings of a given business. And the market's saying that they think the earnings stream of automotive retailers is 37% better today than it was just 6 or 7 months ago. So what the markets are saying about these disruptive technologies and how these disruptions impact profitability is they're just not buying it. The current consensus is that disruption is either too far out or too unlikely to impact profits, and the profit outlook remains really strong. And this is very consistent with our view at Kerrigan Advisors. We continue to see evolution and not revolution as it relates to the auto retail sector.
Why are used cars doing so well?
This is a really strong part of the business right now. The average dealership's used to new ratio has improved by 13% over 2018, and all but one of the publics are reporting really strong profitability and growth in used cars. As new car prices have risen in recent years, these late model, high quality used cars represent strong value to consumers. And car quality is really high across the board right now, so the attractiveness of used cars has never been higher. I'd also add that information's really improved about what we know about used cars. A lot of consumers are frankly much more comfortable buying used cars today as they can look at a really comprehensive overview of a used car's history. And I think that's really changing the perception of used cars for a lot of consumers. In fact, on this point, Lithia CEO Brian DeBoer said their current used to new ratio is about 1-to-1, and he wants to radically increase this to 2.3-to-1. Now that's a major shift in business model for a company the size of Lithia.
Any other news in recent weeks?
Well, I have to mention the surprising news out of AutoNation. They replaced their new CEO with Cheryl Miller, who had been their CFO. AutoNation just ran a very public search for the successor to Mike Jackson and named Carl Liebert just a few months ago. And even while announcing a great quarter of results, AutoNation surprised the industry recently by appointing Cheryl Miller as the new CEO. There's been a lot of turnover in the executive suite in AutoNation, and this is just the most recent episode.
All right, well, thank you, Ryan. It's always great to get your perspective, and we look forward to talking with you next month.
Happy to do it, Bridget. I look forward to talking to you next month.
Thank you for watching the official news source of the retail automotive industry.
This has been a JBF Business Media production.